Hello, everybody. Thank you for joining us this morning. My name is Chris Wilson, and I'm the Head of Business Development here at Myerson Solicitors. Today, we're going to be talking about the hot topic of employee ownership as a succession planning model for businesses. We're going to be looking at employee ownership trusts, delve into their tax advantages, how they're structured, the benefits to the business and its employees. If you are considering your succession planning options, then employee ownership model is certainly one for the list. We're joined today by our expert panel, and I'd like to introduce you to Terry Moore and Simon Nolan from our corporate team. Terry and Simon have a wealth of knowledge advising businesses on their succession planning, including employee ownership trusts from a legal perspective. We also have Joanne Henderson, partner in our Myerson employment team. Jo advises clients on the HR and employment elements of converting to an employee ownership model, as well as helping clients ensure that their EOT communication plan is in place. And this includes employee awareness, process transparency, and engagement to ensure that the culture of a business is maintained, enhanced, and thrives, obviously, under an EOT model. We're also joined by Hassan Hashmi and Rob Richardson from MHA Accountants, who are also at the forefront, really, of advising employee-owned businesses on their tax, accounting, and corporate finance elements of any conversion. And finally, we're joined by Michelle Mullaney from MHA, who's going to be undertaking a Q&A session with Richard Gehagen, the CEO and co-founder of We Are Adam. We Are Adam are an award-winning search and selection consultancy. They specialize in recruiting C-suite, HR, marketing, sales, and professional services people. We became 100% employee of business back in 2023, and it'd be great to hear about their journey and Richard's experience of becoming and operating an employee-owned business. Now, as some of you will have seen in the press over the last few weeks, I'm very proud to confirm that Myerson Solicitors has now become the first 100% employee-owned law firm in Manchester. There are probably only about 20 out of 9,500 law firms who've adopted the employee ownership model in England and Wales. And depending on the Labour budget announcement in the coming weeks, there is a possibility that we're going to see many more businesses, especially in the professional services sector, becoming employee-owned in a short space of time. Now, as Joe's going to come on to later, becoming an employee-owned business isn't all about the tax savings. When it comes to Myerson, we've always had a people-first culture, and our ethos has been to remain independent and only grow organically. So tax advantages aside, becoming 100% employee-owned really does reaffirm our commitment to this. It aligns with our core values as well. It allows us to give every single one of our employees a stake in a firm's financial success. It empowers our people. It helps us attract top talent. And it really does reinforce our people-centric culture. Today, we probably won't have time to deal with any questions you may have live on the webinar this morning. So if you do have any questions, you are more than welcome to put them into the Zoom chat. And then we'll provide the answers as a Q&A in the follow-up email. You can also contact any of our speakers directly too. They're going to be more than happy to speak with you, and we'll make sure we share all their contact details again at the end of the webinar. So succession planning is clearly high on the agenda at the moment for businesses and for business owners, and the EOT model is really beginning to take center stage. Terry, I'll probably come to you first, please. If you can just explain to us a little bit more about the EOT model, and why becoming an employee-owned business is an attractive prospect for businesses.
Yeah, absolutely. Thanks, Chris. Hello, everyone. Delighted you could join us. Chris, as you mentioned, the EOT model is really a form of succession planning and a means to achieve employee ownership, first and foremost. EOTs, they're formerly known as employee ownership trusts. They were established in 2014, so they're about a decade old at this point. And the intent was really to promote greater levels of employee ownership across the UK. I'm sure people will have come across some of the better known EOT businesses, Waitrose, John Lewis, Richer Sounds. They've sort of helped to publicise the model. And the model's attractive, really, because it brings about a number of benefits to various different persons involved within the business. first and foremost, from a succession perspective, it can provide stability by promoting a long-term ownership solution. And it also gives back to the employees and recognises, their contribution and the culture of the company. It also has a number of different benefits to the sellers and the business and the employees from a tax perspective. Hassan will no doubt speak about these in more detail shortly, but the 0% capital gains tax rate is very attractive for the selling shareholders. There are tax-free bonuses available to the employees. So they have acted as, incentives for those who were perhaps previously thinking about employee ownership and wants to explore it in greater detail. I think there's been a number of studies as well, Chris, which have also shown that the EOT model can encourage and promote productivity and staff retention. It can also help with recruitment and satisfaction. So there's plenty of different benefits. I think they are growing in popularity. We're certainly seeing more of them here at Myerson, including, of course, our own transition. And yeah, I suspect, Chris, that as time goes on, we'll see more of them, and they will continue to be a popular model.
Super. Simon, I know you deal with a lot of the sort of technical points when it comes to EOT conversions. I was wondering if you could explain sort of exactly how the employees acquire the ownership of the business, and what kind of structure is used to achieve it.
Yeah, sure, Chris. So an EOT is a trust-based structure. In a nutshell, a trust is established for the purposes of acquiring and owning the shares in the trading company for the benefit of the employees of the company as a whole, thereby creating indirect ownership of the company by its employees. An EOT usually has 3 individual trustees or a single corporate trustee, which is normally a company limited by guarantee without share capital, with at least 3 of these 3 trustees as directors. It's best practice for one of these individual trustees to be an independent EOT trustee, and for at least one of the EOT trustees to be a serving employee who is also not on the company's board of directors. It's often the case that also one of the board of directors of the company is an EOT trustee too.
And this is exactly what we did at Myerson. We appointed a corporate trustee to maintain continuity. If one of the trustee directors wanted to step down or retire, and obviously we've got 3 directors, a representative from the original business owners, an independent who's not involved with the business, and then obviously an employee representative too. Terry, coming back to you, at the beginning I mentioned obviously that EOTs are taking more centre stage when it comes to succession planning. What trends are you seeing with the businesses that you're speaking to and the EOTs that you're setting up when it comes to actually being EOTs?
Yeah, Chris, well, I think there is a definite upturn in the model. It's as I mentioned, it's 10 years in the making at this stage, and the tax incentives have always been there, but I think it's probably been a bit of a slow burn, and it's remained a fairly niche model. I think the latest data was that as of October 2023, there were just over 1,600 employee-owned businesses in the UK. So you can see, compared with other types of ownership models, it does remain fairly niche. But having said that, it's a positive sign. It's a good trend. And I do think there is a trend towards certainly the concept of employee ownership, and also trying to resolve some of the succession issues, which we touched on earlier. I think also just anecdotally, we've noticed an increase in the number of transactions. Probably 5 years ago, that there were very few EOTs, which we were working on in the corporate team here at Myerson. Myself and Simon, have probably the same number we would do in the first 5 years of the EOT legislation, probably on the stocks right now in terms of just volume of the EOTs. So Whether it's anecdotal, I'm not sure, but there certainly seems to be, over the last 12 to 24 months, a big sort of, sway towards looking at this model. And it's fairly obvious why that is, because it does resolve a lot of succession issues, and it brings about those tax incentives, which I mentioned earlier as well. Obviously, with the Labour budget, the first Labour budget coming up on the 30th of October, that's been touted to be pretty significant in terms of what that might mean for capital gains tax. We don't have, a crystal ball, and I'm sure Hassan will have been pondering on this as well. But one thing I would say is that if CGT does change, then there may be an even greater influx towards employee ownership, because it just really solidifies those benefits. And just probably one other point to mention, Chris, is that in terms of sectors and trends in that sense, one thing we have noticed is really people-based, service-based industries have really seen a bit of an uptick in terms of the use of the model. In particular, professional services, we've seen a lot of law firm interest, company secretarial interest, architects, those kind of businesses where they really rely on the employees who are there providing the service. They seem to be, part of a trend towards looking at employee ownership as a succession model.
Thanks, Terry. And obviously, Hassan, coming to you, you help many business owners with their succession planning. And obviously, a key element then, as Terry mentioned, is actually understanding the various tax positions and what those tax advantages are of becoming employee-owned businesses. Can you give us a little bit more about what those tax advantages might be, maybe for both the business owners and the employees?
Yes, thanks, Chris, and good morning to everyone. I think Terry's given a really useful overview of the landscape, and I agree with all that he said. EOTs have been around for a while, about 10 years or so, but there's definitely been an uptick in interest in them recently for all the commercial reasons that Terry's mentioned. From a tax perspective, they are highly beneficial, and I suppose that is part of the government's, of any stripes, policy is to encourage employee share ownership, whether that's directly via things like the EMI or other share incentives, or indirectly through an EOT structure. As Terry mentioned, the main benefit, headline benefit for the owner of a business is that on a sale of a trading company by an individual or a trust to an EOT, that sale or gift is free from capital gains tax. So that's a really generous and compelling tax benefit associated with transitioning to employee ownership. As has been mentioned, we don't have a crystal ball. We don't know what's going to happen in the future, but with the widely expected changes to capital gains tax that may be coming in the next budget, it may become even more attractive. Chris, you mentioned that there's benefits to the employees of an employee ownership trust structure, and there is. The main benefit is that all employees are entitled to an annual bonus of up to £3,600 tax-free. That £3,600 limit has remained the same since it was set. The employee ownership structure was set up, and there have been calls for that to increase. So watch this space. Who knows? It should be noted, though, that although at the moment there is this ability to pay an annual bonus of up to £3,600 to each employee free of income tax, there isn't an equivalent exemption from national insurance. So unfortunately, at the moment, even though the bonus is free of income tax, national insurance, both employee and employers, does arise on that bonus. There have been calls for the national insurance treatment to be aligned with the income tax treatment to make the bonus really beneficial to employees. So let's watch this space. There are also inheritance tax reliefs associated with sales to an employee ownership trust. I guess the policy objective of this is that if a business owner were willing to sell shares or give shares to an employee ownership trust at less than full market value, there aren't any negative inheritance tax implications for the business owner. So again, that's something which might be aimed at encouraging a business owner, should they wish, to sell at less than they might otherwise get for their shares, thereby sharing part of the tax benefit of not paying capital gains tax on the sale of the shares with the trustees. There are also a generally benign inheritance tax regime for both the company and the trustees of the employee ownership trust. Again, this encourages transition to this employee ownership structure.
And I think, Hassan, taking in order to get to the point where you can take advantage of these real good tax incentives, I also understand that there are several conditions that are going to need to be satisfied in order to obtain these tax reliefs. Can you talk a little bit through what those conditions are?
Yes, Chris, that's fine. So, I mean, the tax benefits are really beneficial. So there are some T's and C's attached to getting this beneficial tax treatment. They're not particularly onerous, but in summary, they are the business being sold must be shares in a trading company or the holding company of a trading group. As a result of the sale to the EOT must own more than 50% of the company's ordinary shares, votes, and also if the company were to be wound up, the trustees would be entitled to receive more than 50% of its value. The benefits of the employee ownership trust must be available to all employees. Previous shareholders who own more than 5% of any share class in the company are included from that. All employees must be able to benefit from payouts from the trust on the same terms. However, that doesn't mean that all employees must receive the same amount if there is a payout from the trust. The trustees can differentiate between the employees on certain limited criteria, being the level of salary of that employee, their length of service, and the hours worked. Finally, there's a requirement that the number of shareholders who continue in the business as employees or directors after the transition to employee ownership can't exceed 40% of the total number of employees.
Thanks, Hassan. And picking up on another point that I came across, obviously, when we were doing our conversion is about ensuring that, the trading company actually is a limited company and not an LLP. And obviously, most professional services companies are LLPs originally. So we did exactly that. We went from being Myerson Limited. Well, we went from being Myerson Solicitors LLP to Myerson Limited. And then obviously the limited company sold the shares to the employee ownership trust. So yeah, it's a really interesting point, trying to make sure that you do sort of meet those criteria beforehand. And that's something that I'm sure you, Hassan, and Terry and everybody else can talk through with people if it's something they want to hear more about. Now, Rob, just coming on to you, actually, we're obviously talking about EOTs this morning. However, to give some context to the wider topic of succession planning, what other forms of succession might selling shareholders and business owners want to consider? And what do you think the advantages or drawbacks might be of these when we compare them to employee ownership model?
Okay, thanks, Chris, and good morning, everybody. I think just like the team at Myerson's, we're beginning to see EOTs become increasingly popular. But I think it's really important to stop and consider what other exit options there are as part of weighing up whether an EOT is the right solution for the shareholders. And the main alternatives tend to be an MBO, a trade sale, or maybe a sale to private equity. So just looking at those in turn, in respect to an MBO, I think the key advantages are the ownership passes to the key management, who arguably are becoming incentivized to sort of drive the business forward and becoming the next leaders of that that business. An MBO is also, from a funding perspective, much more familiar to funders, and it becomes easier to raise third-party debt to increase the initial consideration that can be paid to those vendors. EOTs, on the other hand, can be a little bit more challenging to fund, and there are fewer funders at this stage who are willing to look at them. Other advantages of MBOs, the MBO transaction, like an EOT, can be fairly friendly, as both parties know each other, so they can be done fairly quickly without too many extra conditions in there. And then finally, I think an MBO provides great continuity for staff and for customers and as suppliers, because it's seen as less disruptive because it's basically the same team that's taking it on. In terms of disadvantages, it's for an MBO and occasionally for an EOT as well, that the value can be lower because ultimately it's the business that is having to fund the purchase price, which can take time, and you need to set those expectations just a tiny bit lower in terms of value. And finally, I suppose the disadvantage of the MBO is that sometimes it can leave a gap in the management team, as those vendors begin to step away. Looking at trade sales, the advantage of that exit route is often you can achieve a higher price, especially if it's a strategic purchase, as buyers are often prepared to pay more for the business. And not only that they're also often pay a greater proportion of the initial consideration at completion, so you tend to get your value or your money a little bit quicker. In terms of downsides or disadvantages for a trade sale, process can be more involved. It can often require quite extensive due diligence. There's often a need for much wider range of sort of warranties and indemnities that you typically see in an MBO or an EOT. I suppose the other disadvantage on a trade sale is you quite often see an element of your price or the value being linked to future profitability, as a sort of an earn-out type of model, which can create less certainty around what the ultimate value is and how much you receive for the business. And I suppose finally on a trade sale, ultimately there's going to be a change in ownership. So this can be really unsettling for staff and for customers, but that change in ownership just creates that sort of uncertainty. And then the third sort of exit option I mentioned earlier was a sale to private equity. Advantages: private equity tends to work really well for those sort of growth businesses, those businesses with real potential. It often provides growth capital to help you achieve that and additional expertise to help realise that growth. But I suppose on the downside or disadvantage, they tend to be very complex deals. They tend to be very involved from a due diligence and structuring perspective, and they leave you working with a third party towards another transaction, which again can be a really big cultural change for certain businesses and can be quite unsettling for its people.
Thanks, Rob. So it really is important that the people really think about, what route they're going to go down, maybe have them all assessed. This is something that MHA and Myerson can both help with, making sure that you look at the pros and cons of each one and work out which route is best for your business. Now, as I mentioned at the beginning, obviously becoming an employee-owned business for us at Myerson wasn't just about the tax savings. It's about providing our employees with continuity and stability, enabling us to, positively grow our business together. So, Joanne, coming to you, how does the EOT structure achieve sustainability, and what are the mechanisms in place to maintain culture and values?
Morning, everyone. Picking up on the employee side and picking up on some of the things that Rob said, this is still a change, and a change in ownership like this it can be unsettling for employees, or at worst parts make them suspicious. And hopefully that's not necessarily in the case that where a business already has a well-established culture and values. But I think all employers looking at this option must be mindful of the fact that change does have the potential for disruption, and it has a potential adverse effect on retention potentially too. So it's really important to be as transparent as possible and to provide timely information and reassurance to staff. And in my experience, there's also a real employee relations opportunity to be taken. In addition to the tax benefits to employees, employees will benefit through this option from increased levels of participation and engagement and influence over the business in which they work. For those reasons, it's essential to have a really carefully considered communication plan from the outset to ensure that employees understand the process and they understand the advantages. So it's necessary to address misunderstandings from an early stage and allow plenty of time throughout the transaction for questions and discussion. And providing that early information will reassure employees that culture and values can be protected and grown. The transactional side of this option can be quite complex, but as with all employee communications, the fundamental requirements really are being straightforward, timely, and honest about what's happening. And that might mean producing communications in different styles and forms and delivering it at different times to various categories of employees. And engaging early with HR support and senior managers will assist in generating trust and understanding. Hassan has mentioned that an EOT is only possible where you have an incorporated business. And for some businesses, especially professional services, as we've said, there is a requirement to incorporate in advance. That incorporation is a change of employer, and that might trigger additional obligations around information and consultation under TUPE. And so it's going to be important to factor in those requirements to the timescales you're looking at. It might also involve additional requirements like new contracts of employment or new remuneration structures for employees. And having time to plan and discuss and agree those changes is going to be an important part of keeping employees feeling settled and involved. Looking such as to the post-transaction phase of this, careful consideration needs to be given to implementing an appropriate structure for employees to be properly involved. So employers need to create time and space for employees to get to know the EOT trustees and to understand their role. And additionally, employers need to give some careful thought to the structure and the mechanism of employee engagement. A successful representative body will have clear terms of reference and be properly representative of the whole of the employee population. So making sure that you've got that effective employee forum and facilitating a collaborative relationship between the staff, the EOT trustees and the board will ensure that employees provide a genuine and considered collective voice that can add real value to the business. And experience tells us that that voice can improve rates of productivity and growth. So employers who have planned well can share their proposals for this new approach towards governance and involvement in advance of the transaction and provides a real, genuine employee relations opportunity in a sense that not only will culture be protected, but that there's a real opportunity for employees to influence and grow their own workplace culture going forwards.
Thanks, Joe. And obviously that's exactly what we did when we became EOT. We were transparent. We educated all our people on the process, what it means for them, how they can contribute going forward. And it really did make a massive difference, especially when you compare this approach to, say, how most private equity transactions happen. You know, more often than not, employees are told on the day that the business sale goes through. And it's a real shift and change from the way you approach an EOT. Simon, just coming back to you, I've got another technical question for you. When a business is thinking of becoming employee-owned, what are the transaction elements and what transaction elements do business owners need to think about in advance and prepare for?
Yeah, sure, Chris. So whilst creating an employee-owned business has many advantages, there are some pitfalls. It's important to take professional advice in planning and structuring the transaction. As part of the sale process, you'll need to consider various factors which will need to be agreed between all the selling parties. And this is where there is some potential for EOTs to fall down. This is just because simply the selling parties just can't agree between themselves as to what they want to do. EOTs work particularly well for companies that have a small number of shareholders or partners, all of whom are at a similar stage in their professional succession planning, with no one looking to retire for a number of years. You also need to consider various transactional elements, such as the share purchase agreement, the valuation, how the conversion is going to be funded, what deferred consideration position might look like, and whether this will affect day-to-day cash flow and operations for the ongoing management. You also have to consider whether you're going to make any changes to the ongoing management of the company. Some of the factors you also need to deal with could be regulators. In the case of law firms, for instance, this could be the SRA. And you'd also have to consider factoring time frames for accounting for possible delays when dealing with regulatory bodies. If you also have to convert from an LP to a limited company, you'll need to look at some of the contractual arrangements you have in place with either your clients or suppliers, as new arrangements may need to be agreed and signed between the parties.
Thanks, Simon. So yeah, it's just some things really to consider there, isn't there, when going into that? And again, once again, it's definitely something that MHA and Myerson can both help people with when they come to look to structure in that way. At this stage, I'd like to thank all our panelists so far for their really sort of helpful insights. And now we've got more for you, which is the pleasure of introducing Michelle Mullaney from MHA, who's going to be undertaking a Q&A session now with Richard, the CEO and co-founder of We Are Adam. As I mentioned at the beginning of the session, We Are Adam are an award-winning search and selection consultancy, and they specialise in recruiting C-suite, HR, marketing, sales, and professional service sectors. We Are Adam became a 100% employee-owned business back in 2023, and it'll be great to hear about their journey and the experiences of becoming and operating as an employee-owned business. So, Michelle, I'll hand over to you.
Very much, Chris. So obviously we've heard a lot about the deal structuring, the tax, the legal side, but how does it actually feel? So that's why we've got Richard here today, who's kindly going to share his thoughts, having actually gone through it yourself. So thank you very much, Richard. I suppose, where do we start? Maybe kind of what made you think about and consider employee ownership?
So it's an interesting question because it's a really good conversation for the panel already. And I think it's for me, it's the journey through the different options you've got as a business owner. We were looking at succession planning for quite a long time just before the pandemic. And certainly in terms of employee ownership, a few sort of peer group friends of mine have actually, gone into employee ownership, famous ones being Tangerine PR, people like that. So some great stories about how it engages that kind of thing. But in terms of us, we actually got 2 or 3 very credible approaches to buyers, particularly one in the pandemic, which was probably as good as you would look at a big version of us. It was somebody in London, there was a good geographic split, and it just didn't feel right. I think Rob mentioned about deals and having to stick around for the deals that might not come through. And much as we are a talent business, we are a senior executive headhunting business, at the end of the day, our industry is recruitment. And I think there's probably, we've all got experience of different kind of salubrious characters that operate in that sector, unfortunately. So we're a bit reticent to go into a transaction that might take quite a long time and actually not pan out how we wanted it. So we like the element of control. And, not here to blow the trumpet of MHA, but I had a great experience whereby, the process started really with quite a lot of due diligence from them to us about why we were doing it, what other options we were looking at, about the team that we'd got, about the culture, which I'm happy to go into more on. But essentially, it kind of started to drop out, but that was the right way. Interestingly as well, and we are going back now, probably doing this due diligence during the pandemic. So you're talking people that have probably promoted themselves, and certainly there's a lot of very reputable firms on here that I respect heavily, but other firms that will remain nameless, shall we say. I was going out and doing due diligence on them, and there were a lot of people promoting that they were doing quite active in the EO space, and they haven't done a transaction yet. So again, the thing that stood out for me, certainly about MHA, was it's very obvious that whether we chose management buyout, whether we chose employee ownership, there was a hell of a lot of experience in the MHA team to take us through that. So that was kind of why we went for it in that sense. And I think in terms of the cultural aspect,
we'd put a lot of time. We're still a relatively small team, we're low 20s employees, and we've gone through a lot together. It's got a great culture already. Needs constant attention, of course, but we just felt it was the right thing. We just felt like a trade sale would definitely probably lose the brand and the kind of staff that we built up. It's a natural thing that a lot of the acquisitors we talked to were talking about, where they could cut costs, back office, you name it, marketing. So again, it's just got so many upsides from that perspective. And I can't echo enough. I think 2 or 3 people have said on here, it was never about the tax. I think anybody who's coming into this thinking it's about a tax transaction, and I did in my own due diligence speak to other owners who it was very apparent that is why they'd done it. I don't think it's the right move if that is all somebody's thinking.
Yeah, thanks for your honesty, Richard. I suppose there might be other people dialing in today, or other business owners that are kind of thinking about whether or not this is the right option. I suppose from your perspective then, what are some of the other advice that you would give owners if they were thinking about transitioning to that model? You touched on it a little bit about kind of make sure you do your due diligence. To anything else?
Yes, I think something that's kind of important. Essentially, time of the transaction itself, and also the time that you might or might not have to spend in the business afterwards. So there has to be some very, very honest conversations about the management team and how long they want to spend in it. But I think also that it might have moved on a bit now, but certainly when we were looking at it, a lot of people were talking about how long it takes to kind of go through a process. And in reality, I was quite surprised. Once you've made the decision, it's a much quicker process. So to get to the point where you're deciding whether or not EO is the right move for you and your business, I think you can actually do that much quicker than perhaps people perceive. Yes, there's quite a lot of due diligence you should do. Yes, there's a lot of things to look at. But actually, it's quite a straightforward process, I would say, without obviously undermining all the great work that everyone on this call does. And there's a lot of technical stuff that I didn't have to get involved in. But I would say, yeah, so due diligence is one, but time is the other. Consider how long you want to be in your business, whether you want a quicker exit. I think Rob touched on getting your money quicker. If that's a priority, a trade sale will probably deliver a certain amount of money quicker potentially. And the pain factors. Yeah, there are pain factors, as we all know, about selling a business, whether that's the relationships between buyers and sellers, relationships between your staff and yourself, who maybe not as bought into that process. So my main advice would be to encourage people to talk to professionals early, talk to good lawyers, talk to good financial experts in EO very, very early on in the process and take advice. Don't try and do all the thinking yourself.
So I'm kind of imagining there might have been a bit of a hurrah moment when you kind of get it over the line and you can announce it. But then I suppose you're kind of that little while post deal. So what do you feel have been that more longer term impacts if you think about the sort of culture, for example, as how do you feel from a longer term impact?
Yeah, it's a really good point, that. So I think people were getting excited before it actually happened, to the point where when it happened, it felt like it was very natural, and we'd done a lot of communication beforehand. I think the things that came afterwards were very much around when people came with a problem or a project that they wanted to do. It's more like, well, as an owner, what would you do? So somebody who's not used to perhaps, being completely accountable for a project now feels genuine ownership. So don't get me wrong, we're 18 months in. I'm not pretending that it's absolutely perfect. There is genuinely constant work to do. But I think autonomy, culture, I think, as it's been said on this call already, I think the fact that you've got to get the culture right, we've got to keep working on it. You've got to over communicate, if anything, constantly on everything, and just be so honest. You can't hide anything from the team, and even why would you as well?
Pick up on it. Is there any other benefits that you've kind of felt, again, I suppose more longer term, over and above the culture?
So from a more sort of strategic perspective, I think the big one to sell to staff, whether they're joining us or whether it's the existing team, kind of protecting from raiders or providing whichever positive or negative. So you're either protecting from potentially an unknown sale or an unknown approach. Particularly in our sector, that's really common, whereby, overnight somebody's come in and bought a company. But also providing a long-term career for people. They can genuinely see their role in it. So they can genuinely see what the plans are. They can genuinely see that, I'm actually the oldest in the business at sort of 53. So they probably know where I'm at in my life. But, somebody who's 28, 32, got a lot of years to give, they now can see where this business will go. And I think that's huge for retention. It puts a lot of believability into people's career aspirations. Everybody's development plans are genuinely to replace the existing management team.
Is there anything that maybe you hadn't thought about or you hadn't anticipated when you sort of started on this journey? I suppose both from a kind of challenges and a benefits perspective.
So the challenge, I think, is an easy one, because that was very early on. It was very, very obvious that you've got a lot of people like, wow, this is really exciting. Then you've got quite a few people who are just so ambivalent. I was a bit surprised at that, and I thought really this is just a no-brainer that everybody would buy into it. So I think that's where the work comes in culture. And again, I've said this to other business owners who are going through it. It's not the panacea. It's not just going to fix every problem. So if you've got people that aren't as bought into culture, or maybe aren't the right fit, or not so happy in the role, it won't necessarily fix that. So you still want to work on the way you would have always done it. So that's probably, if you like, the negative one. The positive one, which I don't know why I didn't expect it, but I wasn't doing this to promote it to clients, but the client reaction was unbelievably good. So a little bit like saying you're sustainable as a business, doing good work in the community. I've always done good work with charities, that kind of thing. I didn't expect that clients would be that bought into this, and I don't know why I didn't think that, but that's completely opposite. So we've got a really positive reaction. They can see that we're looking after the team. They can see that we're thinking long term. Whether that's right or wrong, I don't know, but that was a really nice positive reaction. So we do promote that now, obviously, actively.
Do you think there's anything else that kind of you'd like to get that message across that you maybe think we've not touched on, or?
No, I think it's been, certainly listening today, it's been a privilege to hear there's a lot of expert. It's nice to hear it's moving along, because it did feel like we were still quite early 3 years ago when we were talking about this, so that's good. I'd just probably go back to the point, and I say this to everybody who's selling their business, don't feel like it takes forever to make your decision, but at the same time, don't underestimate how much you have to get the buy-in of absolutely everybody, and have 5 times more conversations about things than you want to maybe initially, but just get comfortable with being really honest with people.
Well, huge thanks, Richard, for sharing your experience, and I'll hand back to you, Chris.
Thank you.
Thanks very much, guys. It's great to hear about Richard's experiences about becoming an employee-owned business, and obviously we wish you and all of your staff every success for the future. This pretty much brings us to the end of our webinar and our introduction to becoming an employee-owned business. Once again, I'd like to say thank you to you all for joining us today. I hope you found the introduction to becoming employee-owned helpful. We are out of time, so if you do have any more questions now, you're welcome to put them in the Zoom chat still, and we will answer them in the follow-up email. On the screen, you'll also see all the contact details for our speakers today, if you'd like to contact them directly. Obviously, you can also contact Richard at We Are Adam as well. We'll also circulate to you the recording, and then we'll send you a follow-up email with all the additional questions and the contact details in due course. You can obviously find out more information about EOTs and about succession planning in general on both the Myerson and MHA websites. So once again, thank you to our panel members. Thank you to you for joining us this morning. It's been great to have you, and we look forward to seeing you and hearing from you in the future. Thank you very much.